Welcome to my channel. I am going to walk you through the process of valuing Methanex stock and analyzing its ratios. Comment if you have questions. I respond to every comment. Subscribe if you want to see me value more companies. Methanex is a Canadian company that supplies, distributes, and markets methanol worldwide. It is the world's largest producer and supplier of methanol. This company trades on the Toronto Stock Exchange, but we're going to look at the ticker that trades on the American Exchange since the company reports its financials in US dollars. Methanol is used to produce other chemicals, which in turn are used to produce thousands of products that touch our daily lives, such as building materials, foams, resins, plastics, paints, polyester, and a variety of health and pharmaceutical products. Methanol also is a clean-burning biodegradable fuel. It is becoming a more attractive alternative fuel for powering vehicles and ships, cooking food, and heating homes. Let's get started with the model. This company has a market cap of $1.7 billion. So that's the value of the company according to the stock market. Let's see what they're trading at, $22.90 a share. The way you value a company is you estimate the future free cash flows and then discount that back to today's dollars. That's what we're doing in this video. Now I'm pulling their actual free cash flows. Free cash flow is cash flow from operations minus capital expenditures. Now I'm going to pull their net income. And net income is the profit and loss on the income statement. And I'll put 4 years of that into the model. And then we're going to pull their revenue, which are the sales for each year. Let's look at the financials. They have positive free cash flow each year, which is great. They have negative net income in 2016, but positive the 3 other years. Their revenue grew quite a bit from 2016 to 2018, but then dropped in 2019. But we should get a good value for this company. Let's look at a capital structure. They pay $124 million of interest on their debt. Let's see how much debt they have. We'll go to the balance sheet. We'll go to the liability section. Current debt of $38 million, that's debt due within 12 months. Long-term debt of $1.7 billion, that's debt due after 12 months. They pay 7% interest on the debt. Interest payments are tax deductible. Let's get their effective tax rate. Let's go back to 2018, $811 million of income and $153 million of taxes. Effective tax rate is 19%, cost of debt is 5.7%. Let's pull the beta so we can figure out the cost of equity. They have a high beta, 2.46. So the stock moves 2.5 times the market. The beta is like the credit score for a company. When a company has a really high beta, it's a volatile and risky stock. That's why the cost of equity is really high, 21%. But if they had a low beta, like 1, then it would be 10%. Let's go back to the balance sheet, pull their current assets. We need this to calculate the current ratio later. That's $1.2 billion. Let's see what that is. $416 million of cash, $343 million of receivables. That's how much money other companies owe this company. $281 million of inventory and $8 million of other. Let's get their current liabilities. That's $648 million. Let's see what that is. $38 million of current debt and $26 million of other. Equity is the value of the company according to the balance sheet. That's $1.3 billion, $440 million of common stock, $1 billion of retained earnings. Retained earnings is all your prior net incomes minus your prior dividends paid. This indicates that historically they're operating at a profit. And they have negative $150 million of accumulated other comprehensive income. Let's go back to the income statement and get their EBIT, operating income, $139 million. That's how much money this company makes prior to paying interest and taxes. 57% of the capital structure is debt. Cost of debt is 5.7%. 43% equity. Cost of equity 21%. The WACC, which is a blend of the cost of debt and cost of equity, is 12.3%. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimate a terminal value, which is all cash flows past year 4, that's $3.3 billion. We discounted those numbers back to today using the weighted average cost of capital. and we get a value of the company of $3.9 billion. We divide that by 74 million shares, and we get a calculated stock price of $53. They're trading at $23, so they're trading at a 56% discount. It's a buy according to the model. Let's see what Simply Wall Street says. They're at $70, so they're saying the stock is even more undervalued. Let's see where the stock has been trading at. So it looks like it was trading over $100 a couple years ago, but the price has come down quite a bit. So it looks like it could be a really good value. Let's look at the financial ratios. 19.4 PE, which is a little high. The median in the market is 15.1. 0.5 price to sales, which is really good. The median is 1.8. The average is 5.4. Price to book is 1.3, which is good. The median in the entire market is 2.5, and the average is 5.7. So PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15. They're at 19.4. So investors are paying $19.40 for $1 of earnings. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5. They're at 0.5. So investors are paying 50 cents for $1 of revenue. That's a pretty amazing ratio. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5. They're at 1.3. So investors are paying $1.30 for $1 of book value. Current ratio is good, 1.9. The median is 1.3. The average is 1.8. They have a weak interest coverage ratio of 1.1. The median in the market is 4.1. The average is 13.5. A weak ROE, 7%. The median is 13%. The average is 8%. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2. They're at 1.9. ROE is net income over equity. I like to see above 20%. They're at 7%. Interest coverage ratio is EBIT over interest expense. I like to see above 2. They're at 1.1, so they can just cover their interest payments. This is the only company I did a video of in the industry, chemicals, so I can't compare them to anyone. Let me know what you think of the video. Leave a comment. I answer all comments. And if you want to see me value more companies, then subscribe. Thanks for watching.